Okay, here's a thought. What if the key to building, say, a billion-dollar company isn't just about raising those massive, splashy VC rounds? What if it's actually more like operating strategically, almost like a highly diversified hedge fund manager?
That shift in thinking is really fundamental. It captures a huge change in how sophisticated business building works now.
Exactly. And that pivot, well, it's really at the heart of what we're exploring today, something we're calling the Entrepreneurship Zeitgeist 2030. Welcome to the deep dive. Today we are unpacking four pretty sophisticated blueprints. You could almost call them guaranteed frameworks that seem to define business creation at scale, over the next decade or so.
Right.
Our mission here is really tailored for you, the learner. We're digging into expert analysis from our sources to give you a shortcut, basically, to understanding the precise frameworks folks are using to engineer unicorns. And maybe more importantly, the quiet secrets of long-term sustainability, the stuff that 99% of those fast-growth startups seem to completely miss.
Yeah, what we're really seeing is entrepreneurship evolving. It's moving away from, like, say, accidental luck, much more towards a professionalized science, the lone amateur founder. That idea is kind of being replaced by the strategic orchestrator.
Hmm.
So today we need to analyze these four distinct but crucially interconnected paradigms. They really represent the most sophisticated ways people are thinking about scaling businesses now. And I think for the listener, the ultimate tension we're exploring is this. How do you actually achieve that VC-style hypergrowth while also building in, say, Mittelstand level stability? Is that even possible?
That's the big question. Okay, let's jump right into the first blueprint. This one completely redefines the owner's role. It's serial entrepreneurship, the portfolio mindset. So you basically stop thinking like the CEO of just one company, and you start acting more like a general partner in a really sophisticated venture fund.
Exactly right. And look, this isn't just about, selling a successful company and then starting another one later. It's often a continuous, simultaneous operation. The research points to this core strategy they call the core and satellite structure.
Okay, core and satellite. So how does that work?
Yeah.
What's the mechanism? The core business generates stable cash flow. I get that. But what specific function does it serve for the satellites? Those are the riskier bets, right?
Right. The core is definitely about reliable cash flow, but it's more than that. It actually provides the institutional stability, think back office infrastructure,
Mm.
and maybe most importantly, the established talent pool that these higher risk satellites can borrow from.
Ah, okay.
So this approach, it dramatically lowers the satellite's initial friction, operational friction, and its capital needs because they aren't building HR, legal, finance, all that stuff from scratch every single time.
That's smart. It's like strategic internal resource sharing.
Yeah.
And the numbers, well, they really back this up, don't they?
They do.
Serial entrepreneurs achieve something like 40% better 5-year outcomes compared to founders just chasing those high-risk solo ventures.
Mm.
And this system of, well, hedging, it offers a 27% higher survival rate during downturns. You don't get completely wiped out if the market turns bad on one bet.
Exactly. And what's really fascinating here, I think, is that the sources point to an efficiency sweet spot. It seems optimal efficiency is actually achieved when founders maintain, get this, 3 to 5 ventures simultaneously.
Wait, 3 to 5? At the same time?
Yeah. Less than 3, and you're probably not diversified enough. More than 5, and, well, you absolutely dilute focus. It forces the founder to be a portfolio manager above all else.
Okay, hold on. 3 to 5 simultaneously. Doesn't that just scream diluted focus?
Yeah.
And wouldn't that drastically increase the failure rate, especially for the new ones? I mean, how is that even humanly manageable?
Well, it probably wouldn't be without intense systemization. And this is where that compounding value really starts to emerge through systematic reinvestment. These serial new business builders, they deliver 1.4 times the average revenue and more than twice the ROI compared to non-serial builders. Why? Because they efficiently use profits from the stable core to fuel the next satellite.
Okay, systemization.
And to manage all this complexity, they often set up what are called new venture factories, NVFs. Think of an NVF not just as like a department, but a specialized internal incubator. It produces standardized playbooks, tools, repeatable processes. They're using the same legal templates, maybe the same marketing launch sequence, the same tech stack for every new business. This allows for really rapid, precise launches. It's almost like franchising your own startups internally.
Wow. Building a factory whose job is to build more factories, essentially. That sounds intense, maybe expensive up front,
Yeah.
but you can see how it pays off in sheer velocity. Okay, so if Blueprint 1 is about managing risk, building this stable system, Blueprint 2 is the opposite. It's the ultimate pursuit of speed and scale, right?
Pretty much.
Let's dive into hypergrowth engineering unicorn status.
Yeah, this is the path that gets a lot of headlines, and it's become, quite systematized. Our sources detail what they call the unicorn success architecture. So on average, the median unicorn raises somewhere around $275 million, dollars, and that's typically spread across 5 funding rounds before they hit that billion-dollar mark.
Right, $275 million across 5 rounds. And here's where we see that interesting global nuance you mentioned earlier. U.S. unicorns, they typically raise more, maybe $320 million. But European unicorns, they seem noticeably more capital efficient, often raising only, what, $180 million for basically the same outcome?
That's right. It really highlights that super fast growth doesn't always have to mean, just burning through cash recklessly. Efficiency, especially early on, really matters.
So how do they sustain that kind of exponential growth without just imploding?
Well, the key framework seems to be the dual transformation methodology. This is critical. It means they are simultaneously optimizing their existing core business operations, milking the cash cow, so to speak, while at the same time building entirely new business units designed for future markets.
It sounds hard, like an organizational paradox almost.
Hmm.
How do they manage allocating resources to both protect the old and build the completely new?
Yeah, it requires real discipline. It means having distinct teams, separate budgets, different governance structures even. You've got one team whose job is purely to protect and optimize the existing profit engine, the core, and then another team whose mandate is totally different. Build the next machine, the future innovation. And the data shows that companies investing a critical 20% of their growth capital into building these new ventures, they actually achieve 2% higher overall revenue growth than companies that kind of starve their innovation pipeline to feed the core.
Huh. So that 20% budget is almost like the price of admission if you want future scaling. And this whole effort gets accelerated by certain boosters, right?
Yeah, there are several key accelerators. Things like making the big, often painful process changes needed for going up market to serve large enterprise clients, or, geographic expansion, or perhaps the most ambitious, market category creation, where you're not just competing, you're actually defining a whole new competitive arena yourself.
Okay, so that model speed, big valuations, lots of capital, it's incredibly seductive, isn't it? It's basically the Silicon Valley dream.
It absolutely is. But as the sources remind us, that relentless velocity often burns through cash and founders. Which brings us neatly to the counterpoint, Blueprint 3. This one basically rejects the whole exit-driven mindset.
Right, the crucial third model, the new German Mittelstand, sustainable profitability, a very different philosophy. This framework operates on, well, generational timelines. It prioritizes long-term profitability, stability, job creation over just a quick, flashy exit. The focus is definitely generations, not quarters.
Exactly. And this resilience, it seems to rely on 4 foundational pillars. The first one is global niche dominance. These companies achieve this razor-thin focus. They aim for exceptional quality and highly specialized products, maybe just one key component, which they then distribute internationally. The goal is to be the indispensable global provider of that one specific thing.
Okay, indispensable. And the second pillar, enlightened family capitalism. That seems crucial for the long-term view. What does that actually mean in practice?
Well, typically it means the family that owns the business also runs the business. They combine ownership and control, and that enables this multi-generational perspective where decisions get made for the long-term health of the company itself, not just to, maximize the next quarter's stock price for outside investors.
I see. That commitment then shows up in their investment strategy.
Absolutely. These middle-stand companies, they invest an average of 5% of their revenue in R&D. Now compare that to the German national average of maybe 2.8%. It's significantly higher. And that persistent R&D, it isn't just about getting patents. It's about continuously widening the technological gap between them and any potential competitor. It builds this really strong, almost impenetrable moat over time.
And that translates into financial stability too, right?
Huge stability. Actually, for the first time ever, small and medium-sized enterprises in this sector now have higher equity ratios than large companies. They're fundamentally self-financing, which makes them incredibly resilient to external economic shocks.
Okay, here's a detail I found staggering, related to that long-term mindset, but on the human side. Employee loyalty. Because the work environment is designed to be sustainable, the average tenure for employees in these middle-stand companies is 10.3 years. Compare that to maybe 7.5 years nationally in Germany.
Wow, that's a big difference.
It is. And think about what that means. Lower training costs, vastly superior institutional knowledge just walking around the building.
Hmm.
It has to dramatically boost productivity. It's like this hidden bonus you get from loyalty.
That's a great point. And, the supposedly ancient model, it's also adapting. Over 70% of manufacturing execs now believe circular business solutions sustainability will actually boost revenue by 2027. So sustainability isn't just a cost center anymore. It's being fully integrated as a genuine growth strategy.
Okay, so we've got the diversified portfolio builders, the engineered hyperscalers going for broke, and these long-term sustainers. Now, here's where I think the really deep value lies, right? The future isn't about picking just one of these models.
Exact.
The real competitive advantage seems to emerge when you can synthesize them somehow. Combine that serial entrepreneur's risk mitigation with hypergrowth ambition and sprinkle in some middle stand sustainability.
That's the synthesis. And achieving that kind of convergence, well, it absolutely requires a global vision. Which brings us to our final operational pillar, cross-border entrepreneurship. Going global isn't really optional anymore for ambitious companies. Digital globalization, the flow of data, digital services, it actually represents a larger economic impact now than traditional trade in physical goods. So if you're only targeting your home market, honestly, you're missing the bigger game.
Okay, but what's the playbook for succeeding globally?
Yeah.
Especially when you're dealing with wildly different legal systems, cultures. I mean, you can't just copy-paste your U.S. strategy into, say, South Asia and expect it to work, right?
No, definitely not. Success here relies heavily on what the sources call entrepreneurial adaptability. This means developing specialized skills like cultural intelligence, really understanding and navigating diverse norms, and critically, regulatory navigation building systems to ensure you stay compliant across all these different jurisdictions. You have to build systems flexible enough to handle, say, the rapid regulatory changes in Mumbai and the really extensive consumer protection laws in LA potentially at the same time.
Okay, this brings us right back to that critical question we sort of teased at the beginning. How does one person, one founding team, manage a portfolio of 3 to 5 potentially global businesses,
Right.
execute that dual transformation thing we talked about, and maintain maybe a 5% R&D budget for the long haul? How is all this complexity managed without the founder just completely burning out?
Right.
This has to be the answer we promised earlier, the AI force multiplier.
This is absolutely the connective tissue. Technology, specifically AI now, is what enables the practical convergence of all four models. What we're seeing in temporary entrepreneurs deploying agentic AI systems. Now, these aren't just single tools. Think of them as sophisticated automation layers. They can execute tasks autonomously across the tools you already use. Slack, Notion, HubSpot, maybe localized CRM systems in different countries. They create these seamless AI-driven workflows.
Right, so think about all that operational friction we mentioned. The AI can potentially handle a lot of that noise, right? Managing compliance deadlines across countries, maybe translating market research automatically, updating databases across multiple ventures.
Exactly. It frees up the human, the serial entrepreneur, to manage a far larger, more complex portfolio much more efficiently because the AI is handling the operational drudgery.
And generative AI specifically is speeding up the R&D and testing phase too.
Yeah, absolutely. It allows entrepreneurs to test new marketing strategies or even entirely new business models in literally days instead of weeks. That drastically cuts down the development cycle time, especially for those riskier satellite ventures.
It feels like it's rapidly becoming core infrastructure, not just a nice to have.
The data definitely confirms this shift. Something like 60% of business leaders say they want to launch generative AI-enabled businesses within the next 5 years. So AI isn't just a feature anymore. It's becoming the fundamental enabler for success across all four of these blueprints we've discussed today.
Okay, and speaking of global blueprints and where the opportunities are, let's leave you, the listener, with one final, quite concrete geographic insight from the sources. For anyone looking to launch internationally right now, aiming for that cross-border success we talked about, the source material highlights India as being the most promising destination for, say, 2025, 2026.
Yeah, that potential seems to be driven by two pretty strong government initiatives, Make in India and Digital India. They're creating a really strong environment for particularly digital service expansion, which is why India is projected to be the fastest growing major economy globally during that period.
Interesting. Okay, so let's just quickly recap the 4 big cornerstones of this Entrepreneurship Zeitgeist 2030. First, serial portfolio management, thinking like a diversified risk manager.
Hmm.
Second, engineered hypergrowth, systematizing that path to unicorn status.
Third, sustainable mittelstand, focusing on that long-term, high-quality profitability, thinking in generations.
And finally, digital cross-border operations, the essential global market approach, increasingly enabled by AI.
And pulling it all together, these sophisticated models, they really demand a fundamental mindset shift from founders and leaders. You need to stop thinking perhaps like a traditional owner, focus maybe on just a single product or service, and start thinking more like a VC managing risk, like a growth strategist constantly optimizing efficiency, and like a global operator who leverages agentic technology to scale.
Which leads us to the final provocative thought for you today. When you integrate these different paradigms, the potential for economic impact seems unprecedented. So the question really becomes, are you just building a single company, maybe designed for a relatively quick exit? Or are you actually creating a system designed to build wealth across generations and across jurisdictions? Something to think about. Every insight gets deeper on the second listen, so make sure you save this deep dive in your library. Now, next time, we are unpacking a secret source that reveals the top 3 high-paying skills many people think are safe that look set to be completely automated by agentic AI by 2028. We're talking about roles currently considered highly skilled, highly paid. You absolutely do not want to miss that analysis. Make sure you subscribe